Okay, we're going to talk about retirement planning in the context of taxation. Okay, so this is something that being the number cruncher analyst I am, I look at an IRA and all the money that just floods into IRAs and KEOs and SEPs and so forth. And to me, the IRA is the Gatorade of the investing environment. And I mean that as a pejorative, meaning Gatorade does a great job of marketing their drink, but it's basically sugar water. And yes, professional athletes are drinking out of Gatorade cups during the games and whatever they're competing in, but is not, I guarantee you, they are not drinking Gatorade. I mean, I competed at a very high level in athletics, and you do not drink sugar water while you're competing. They're drinking, a combination of a bunch of other things. And so the point is, there's a lot of hoopla out of how great the IRA is, and I want to, that's what the point of this video is. I want to walk you through the math of it so you really understand and can make a solid decision on your own. So when you look at, you have two pools of money. You have taxable pools of money and you have tax-free. Okay, your taxable pool is basically broken into two components. On this side you have stocks, you have mutual funds, you have real estate. All this is treated with capital gains treatment generally, right, if you do it correctly. On this side you have your income, how you're paid in whatever profession you have, and then anything that is tax deferred, IRA or an annuity, as you take it out, that's treated as regular income. Okay, on the tax-free side we have a circle, and this is munis, muni bonds. The income, right, the interest is tax-free. Growth on the bond is not. That's over here on this side. You have your Roth IRA, which I'm a huge fan of Roth IRAs, and you have a life insurance. That's about it, folks. That's about it, all you have on tax-free. So when you're looking at priorities, there's actually 4 buckets. You have your free money. So how do you get free money? Well, really the only way I know how is to inherit it. So the second bucket is tax-free money, and we just talked about that over here. So this is your Roth, and this is your life insurance. Okay. The third bucket is tax-deferred. So this is all the IRA, 401k, and regular annuities. Then your fourth bucket is taxable. So that's just everything else. Now, as far as priorities and retirement planning in the context of tax, you want to go left to right in priority. Now, I guess I miss my rich uncle, so I don't even have this first bucket, but somehow over time this IRA 401k thing got moved over in front, got moved over here as far as preference, and I want to kind of address that. I want to debunk that. So let's talk about, and there's reasons why, right? So I understand why an IRA and a 401k are popular. You get your deduction for putting the money in, and if you have a 401k, maybe you get a company match, and then you have lots of choices, and it's flexible. I understand all that, but let's look at the math of taxation, right? So here's the money you put in, and let's say this portion of it right here, this was your company match, and then this is the part you defer in your salary. So this part here we already mentioned, this is, we get a deduction for that. Okay, then the money over time, it grows. Okay, the problem is when you're ready to take it out, guess what? All of this is what? It's taxable. And what rate is it taxed at? It's taxed at your ordinary income tax rates. Now, The other alternative on the tax-free side is you pile the money the same way, whether this is Roth or life insurance. This is after tax, right? This is after tax money. So you don't get the deduction, but I'm going to make a point about that in a second. Then your money grows the same, right? Because we're using all basically the same instruments. So you end up with the same pile of money, but when you're ready to take it out, this right here, all of this is tax free. And it's just smarter overall investing, and people just don't pay attention from this point of view, and that's what I really want to address here. And the reason I don't give a lot of credence to this deduction is, if you were taking this deduction and taking that money and putting it in a savings account and growing it over time, I would give you bonus points for that. But you know what? Nobody does that. We just don't. We're spending that money in our ordinary life, right? So I want to draw some lines in the sand here. Line number one is that if you have kids less 10 years old or less, okay, you need to look at the private pension that we are experts at. This is what we focus on doing and make our clients happy with, is the private pension that you can do for not only doing this, the tax-free, but also saving for kids. So that's line sand number one. And this is also, this includes 529. So here's my second point. If you have a 401k match, okay, if you have a 401k match, it's a push whether a private pension or a 401k match is better for you. And I have a separate video, and the video is 401k 529. Go watch that. After you watch this video, go watch that one, and I'm going to explain why it's at best a push of the 401k, because you're getting matched. Your employer is giving you, free money, if you will, in that sense. The third line in the sand that I want to draw here is that if you're just doing regular IRAs or SEPs or KEOs, if you're self-employed, if you're doing that, this is a no contest. No contest. You should be doing the private pension instead. And so I'm going to go through the math here in a second, but this is the visual. This is what I'm trying to concentrate on. Everybody focuses why IRAs, the whole Gatorade thing's become very popular. But folks, when you're taking the money out and it's taxed at ordinary income, and you see the math here, you're gonna see what I'm talking about here. So let me just clean this up. Let me get me a new sheet here, so we can go through all this. Okay. All right. So let's create a scenario here where you have a $150,000 salary. Okay, now you could make more or less than that. That's not what's important. All the numbers here we're going to talk about are relative. This salary is going to increase by 5% over time. I'm sure some of you are saying, man, I wish I had that the last few years. I haven't gotten an increase. You have a 5% increase over time, and our employer, we're going to get a 5%. First of all, we're putting 5% into the 401k, and we're getting a 50% match from our employer. Okay, so the math here is this is going to be $7,500 going in, and then this is going to be $3,250. Okay, that's what's going in first year, and then this goes up incrementally as we're getting our increase. Okay, the point is all this over a 15-year period of time. So this is over 15 years. 15-year period of time, we're going to have a pot at the end of $403,690. Okay, that's if we consistently get an 8% return. Now, we're going to go through a whole different video and talk about returns and net returns and so forth, but I think I'm being incredibly generous giving a consistent 8% growth to this 403. The number we're really interested in is what we get out. So if we retire, regardless if you retire in your 60s, early 60s, late 60s, but let's say we want our money to last 30 years, right? And that is really, that's one of the main conversations we have with our clients, or one of their biggest anxieties is that they don't want to outlive their money. So they're looking for some kind of guaranteed income. With this number, if we, over a 30-year period of time, if we calculate 3.1% inflation, which I think is important to do, obviously over that period of time, that your buying power is going to be inhibited, and we have a 4% internal rate of return, instead of 8. We're being more conservative, and in fact, a lot of people would argue with the 10-year Treasury being below 2%, 4% is where you're going to get that, right? And a 25% tax bracket, which I think is the biggest variable here that we have to worry the most about with our country's incredible debt, and the only real lever that our government has is to increase this tax rate. So anyway, at the end of the day, you plug all this stuff in, we can get out $1,404 a month through this whole period of time. Okay, that's what we can do. So you start taking this out, and then this is net after taxes, and then you grow it with these factors over here. Now, if we had the same 15-year period of time, let's just, for a person who's roughly 50 years old, right, just to try to make the math equivalent, and we plowed in $1,000 a month into a private pension, okay, into a private pension, which is fundamentally equal to what we're putting in with 401k and the employer match. At the end of 15 years, we would be able to get out $1,177 a month, tax free forever. So the point I want to make here is this is 1,177 is a little bit lower than 1,404. Now, the private pension is tax free. You do not have to worry about 59.5 because you don't have that inhibitor. You do not have to worry about required minimum distributions, and the money passes on to your heirs tax free. Okay, all of these issues you have to battle with IRA. Now, these numbers are close. Remember, I said earlier that if you're getting an employer match in your 401k, it's a push, but yet I have this other video that I want 401k and 529. You should go look at that after this video. Folks, if you take this out, right? If you take this out and you're just doing a regular IRA, now you see why I said my third line in the sand is it's not even close why you should do a private pension if you're just putting your own money in, getting a deduction, and because this number is much lower, and that's where the private pension not only gives you more tax-free income overall, but you don't have to worry about all these other issues. Okay, so thank you for listening to my my Gatorade debunking video. Go look at the 529 401k video, and there's also another video on tax distribution of an IRA. And that one's really important as well. I walk you through what are the taxes of an inherited IRA versus a spousal IRA, and there's just a lot of stuff. We see it week in and week out in our practice. People just aren't aware. They made a mistake. They got bad advice. So these are two other videos that you want to take a look at. Okay, but thanks for listening on this one.